can you safely circle the wagons around in what I regard as really a manic, depressive market?
The house of pain.
That veers wildly from deep despair about a potential recession to euphoria that everything's really going to be fine if the Fed cuts rates. You want to find stocks that work either way. That's a theme of tonight's show. Which brings me to IAC Interactive Corp. And that's Barry Diller's conglomerate of media, information, and technology businesses with a stock that's up 38% for the year, hitting a new all-time high earlier this month in the wake of a stellar quarter. Now, I've been recommending IAC for ages, but I want to pound the table once again tonight because this is exactly the kind of secular growth story, doesn't need the economy to do better, that you can count on in an uncertain environment. Remember, the story is very simple. Actually, it's as easy as 1, 2, 3. Within the last few years, IAC has taken 2 of its subsidiary companies public. Match Group, the online dating company that owns Tinder, Match.com, and OkCupid, as well as ANGHI Homeservices, which owns Angie's List and Home Advisor. Both essential sites if you want to do any remodeling. When you add up the value of IAC's stakes in Match and its stake in ANGHI, what you find is you're basically getting the rest of IAC, which is quite valuable, for free. That's been our thesis here, and so far it's worked out fabulously. The stock's up 138% since I first started pushing aggressively in June of 2017 because I saw the bizarre disparity among the pieces. It made no sense to me because it didn't. However, when the company reported a couple of weeks ago, management announced that they were thinking about selling the rest of their holdings in Match and ANGHI, looking for ways to maximize value. We don't know what they're going to do right now. They're just considering their options. But it made us want to sharpen our pencils and check out the math on IAC to make sure we're still getting a bargain with the stock. First, though, let me catch you up on what's happened here. For those of you who don't remember, IAC is a house of digital brands put together by the legendary Barry Diller, the company's former CEO and current chairman, whom I have met. And let me just tell you something. I met him in 1979. I didn't remember him when I saw him again, but man, is he smart. They own Ask.com, Dictionary.com, Dotdash, Vimeo, and The Daily Beast, along with many other brands that you use that you don't even know they own, although Match Group and ANGHI Homeservices account for 2/3 of the company's sales. The thing about IAC is that these guys are masters of taking little digital brands, then growing them big, blowing them out, and then monetizing it. Expedia, Barry Diller. Ticketmaster, Barry Diller. He and his team have created a massive amount of value over the years. Roughly a year ago, I came out here to take a victory lap on our earlier recommendation, but I also pointed out that IAC had become a no-brainer. And by the way, I banned that term from Mad Money. I don't use the term, but I'm using it here. At the time, their stake in Match Group was worth $10.5 billion. Their stake in ANGHI Homeservices was worth $8.3 billion. So let's see, add those two up, you get nearly $19 billion, right, from just those two assets. But IAC itself was only valued at $15.5 billion. You were literally getting the rest of the businesses for less than nothing. It's like that great line from Cramer fave classic, The Warriors. Can you count, suckers? Because the future is ours if you can count. Remember that? Remember? Didn't see it? It's pretty good. That's a good one. You ought to check it. All right. Anyway, at the time, the stock was at 185. Now it's at 253. Turns out that basic arithmetic can be pretty useful in this business. It's not often that the market gives you an opportunity that's obvious, but when it does, man, you got to grab it. Of course, you would have done even better if you just owned Match Group, because their online dating apps have taken the world by storm. Still, I view IAC as the less risky way to play this turbocharged growth story. Match's stock could stagnate, and IAC would still be able to go higher because it would deserve to go higher. Plus, the whole IAC family is doing great. 2 weeks ago, the company delivered a huge 23-cent earnings beat off a 96-cent basis, higher than expected sales, up 12% year over year. Once again, Match Group put up some fabulous numbers. Tinder subscribers rose to more than 5 million. That is up from 1.5 million versus last year, up 1.5 million. I mean, boy, people really must like to meet each other. Isn't that what hookup means? When you drill down, while Match is IAC's biggest division, it's not the fastest growing. Vimeo, their online video platform, saw 26% sales growth. You use that every day, right? Dotdash was up 23%. Mosaic Group, their mobile and business, is on fire. ANGHI Homeservices, meanwhile, actually had some execution issues, including crucial mistakes with how they managed traffic from Google. We saw that happen with Yelp. It happens all the time. Both their sales and earnings came in late. As IAC's CEO Joey Levin, who came on the show, and I loved, put it, I believe our recent issue was as much tripping over our own feet as it was changes in Google's ecosystem. The man is humble. That's another thing I like. When these guys make a mistake, they're not afraid to admit it. They'll change strategy. Now, ANGHI stock was devastated. It was down 25% in a single session. It's continued to fall since then. At this point, ANGHI is down 48% for the year. And there are some real issues that are weighing on the parent company, even if the strength at Match Group is more than enough to offset them. That's the context you need to be aware of when you consider that IAC is talking about potentially doing a full spinoff for either or both of these companies. Again, though, as Levin put it, we sincerely haven't yet decided what's best, although he acknowledges that Match seems like a more obvious candidate for a full spinoff after ANGHI's value destruction. I would agree. So does the math still check out? When we started recommending IAC for trading at a discount to its subsidiaries, it seemed like a slam dunk for investors, and it was. But the longer this goes on, the more frustrated you can imagine IAC's management's getting. Their market values their business at less than zero, and nothing they seem to do can close that gap, even as the stock keeps roaring higher. So on every conference call, Joey Levin implores investors to look at these sum of the parts numbers. I'm going to do some mad money arithmetic, okay? All right, mad math. To me, like when you're adding and subtracting and dividing, that's arithmetic. But anyway, I didn't want to take calculus. That would ruin calculus would have ruined my transcript. I knew better than that. All right, but this is what's called alliteration. Mad math review. Okay. On the latest call, IAC gave us some important details. The company owns 226 million shares of Match. They own 422 million shares of ANGHI Homeservices. That Match Group stake is worth $18.7 billion. As for ANGHI, even with that hideous decline, IAC's position is worth $3.5 billion. Together, these two investments are worth $22.8 billion. With me? Okay. Well, that's puzzling, right? Because IAC itself is only a market capitalization of $21.3 billion. It's pretty simple, right? Let me put it this way. If IAC were merely a holding company that only owned these two businesses, its stock would be worth $264 a share. Yet it's got a host of other businesses, a business with genuine value, and it's only trading at $253. And let's not forget, as Barron's pointed out in its profile this weekend, IAC's got $1 billion in net cash sitting on its balance sheet. Even if you don't care about Vimeo or Dotdash, and I do, especially Dotdash is very good, or any of the other divisions, you're getting $1 billion for free here. And look, IAC has recently made a series of enticing acquisitions and investments. Magisto bolstered its video business and invested, but the one I'm really focused on that I think is just worth a hell of a lot more than they paid, Turo, T-U-R-O. This is a car-sharing app that they paid $250 million for. Turo basically lets you rent out your car to other drivers. Isn't that brilliant? Maybe the next big thing when it comes to our shared economy. Yet IAC stock still trades like this stuff is garbage. I think that's lunacy. So I can understand why management is considering a full spin-off of both Match Group and ANGHI Homeservices. Maybe the only way for IAC stock to really reflect the reality of what Barry Diller's put together. The bottom line, I think IAC is still terrific. I believe they can turn around ANGHI Homeservices. They seem to have a good handle on what went wrong last quarter. And I wouldn't be alarmed at all by the spin-off talk. That's just what IAC does, and they're very good at it. But the key here is simple. As long as IAC stock is worth less than the sum of its parts, it's a screaming buy. We're going to go to Kyle in Illinois. Kyle.
Hi, Jim. Thanks for taking my call.
Of course, Kyle. How are you?
Good. So my stock pick is Redfin. I've been watching it for a while. I own a little bit, and I'm looking to add. But I've been hesitant because of what the market's doing lately. What's your opinion?
Well, Toll Brothers just reported a quarter that was good, but the orders weren't that good. Home Depot had some good things to say about housing, but in the end, residential real estate, stay away. All right, IAC stock is worth less than the sum of its parts. Therefore, I remain convinced that it is a screaming buy. There's much more mad money. How little-known company is competing against the likes of Salesforce and Microsoft and winning? I'll reveal the name just ahead. Then, it's been a volatile few weeks for this market, so how is your portfolio positioned to fight the unknowns like the terrible close today? I'll be the judge of tonight's MI Diversified. And all your calls rapid fire tonight's edition of the lightning round, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.